And we're going to be discussing 3 real estate investment strategies that self-directed IRA investors could benefit from. I'm just going to give you a quick heads up. As I mentioned before, if you have any questions, go ahead and type them into the box there, the questions box, and I will answer them all at the end. I'll read them and then answer them as we get to the end of it. So the first thing I need to put up here legally is that we, the Entrust Group, are not financial advisors. We do not provide any advice. So if you are looking to invest in anything that you're looking to invest in, be it real estate or anything else, we highly encourage you to discuss this with advisors, accountants, attorneys, anybody like that in your life before entering into any type of investment. Again, we provide the administrative and custodial services for self-directed IRAs. We do not give any advice on what you should or shouldn't invest in. What we're going to be talking about, we're going to go over a little bit about Entrust. What are the benefits in general of self-directed retirement accounts? What are the different real estate investment options? This is going to be a very, very real estate-focused presentation. Talking about partnering as one of the strategies, using non-recourse loans, basically leveraging your IRA to borrow money, and then investing through an LLC. And then what the process is to get started, and then at the end is when I'll answer all the questions. So again, feel free to type in your question into the box. For Entrust, we've been in business since 1981, so it's actually a little over 36 years. We currently hold a little over $3 billion in assets. And again, we provide the administrative and custodial services for what are called self-directed retirement accounts. And I'll explain what those are for anybody who might not know in a minute. The majority of our staff are certified IRA service professionals. That's what CISP stands for. We are the only company in our space that provides a national continuing education program. We have a class, a 2-hour, 2-credit class for both realtors, one for realtors and one for CPAs. We do those in person, and it's certain states. It's not every state that we have the continuing education designation. But if you're in one of the states that we have that, then we can come for realtors. We often go to realtor offices, real estate associations, maybe CPA associations, and give this class 2-hour, 2-credit class. And again, we're the only one in our company that in this space that does that. And then we have the IRA Academy, which we actually will train, we'll give a class for other companies to pass the CISP program. So we actually train our competitors on employees of our competitors what they need to know to pass the CISP. So we really are big on the education side of things. So what is a self-directed IRA? Let's talk about that first before we get talking about the benefits. Most people who have a retirement account have it with a traditional brokerage firm or a bank that limits you to only investing in stocks, bonds, and mutual funds. And with Entrust, where the IRS allows you to invest in pretty much anything you want, you just have to have your account with a custodian who will hold other assets besides stocks, bonds, and mutual funds. So that's where the self-directed industry comes in, and where Entrust comes in, is that we provide all the administrative and custodial services for the account. You make all the investment decisions, and if you want to invest in other assets, non-traditional assets other than just stocks, bonds, and mutual funds, then you can do that. You just have to have your account with a company like Entrust. So what are the benefits? You get to take control. Instead of having a broker or advisor that suggests a handful of different mutual funds and tells you you're well diversified, this gives you the ability, if you are interested in real estate, or if you know of some private company, or you have friends that you want to loan money to, or anything like that, you can do all that inside your IRA, so it gives you more control over your own investment decisions. And it allows you to diversify. Instead of having a handful of funds, you can invest in things like real estate or private equity or promissory notes or tax liens or trust deeds. Or we had somebody invest in a racehorse, in cattle, in a bowling alley. Like pretty much anything you want, you're allowed to do inside your IRA, but you just have to have your account with a custodian like Entrust who's willing to hold it. And you get the tax benefits associated with it. If you own real estate personally, each year you're going to report your income, net expenses, and have to pay taxes on that. And then whenever you sell that property, you're either going to have to 1031 exchange it, or you're going to pay capital gains tax on it. But inside an IRA, all the asset is held in and owned by the retirement account. So if you buy property inside your account and then turn around and sell it again, if you flip it or hold it long term and then eventually sell it, or all the rental income, all goes back into your retirement account. So there are no tax consequences associated with any of those transactions until you actually take a distribution from your retirement account. Then you're taxed only on the amount you take as a distribution, not on the transaction, on the sale of the asset itself. So contributions can lower your taxable income, and then the investment either grows tax deferred if it's a traditional IRA, or it's tax free if it's inside a Roth IRA. And as far as what kind of real estate can you invest in, all of it. You name it, you're allowed to do it, other than the fact that it can't be a real estate that you plan on personally living in, staying in, using as a second home, vacation home. And I think I get into a little bit more of who's disqualified from doing that. But as long as it's for investment purposes only, you can buy any type of real estate. You can buy commercial, multifamily, land offshore, you name it, you're allowed to do it inside a retirement account. Again, that's just real estate. You can invest in pretty much anything you want inside a retirement account, aside from real estate. But again, this is a very real estate focused presentation. So some of the strategies that you can use whenever you want to use your IRA. So let's say you have $100,000 in your retirement account and you want to buy a property that's worth $200,000. Right? You think, well, you can't do it. Well, you can. You don't have to have all the cash inside your retirement account. There are other ways to do it. One of those is that you can partner your IRA with other investors. So the concept of partnering is simply that your IRA would be an entity that would own a certain percentage of the asset that you're purchasing, of the property that you're purchasing, and then other investors would also own a certain percentage of that property. So you can partner with anyone you want at the time of investment. So there are rules around what are called disqualified persons, that your IRA is not allowed to engage in what's called a prohibited transaction with a disqualified person. So an example would be your IRA can't buy a property from a disqualified person or sell a property to a disqualified person. But and the disqualified persons are you as the account holder, your spouse, your ancestors, your lineal descendants, and then spouses of lineal descendants. So parents, grandparents, children, grandchildren are all considered disqualified persons. So your IRA can't buy a property from or sell a property to a disqualified person, nor can a disqualified person ever stay in the property. However, on a new investment, as long as you're investing in a property that's being bought from a non-disqualified third party, you can partner your IRA with anyone, including anybody that would typically be a disqualified person. So you could partner with yourself. You could partner with your spouse. You could partner with your spouse's IRA, with your parents' IRA, as long as it's being done at the time that you purchase the asset and on a new investment. And then once the transaction is closed, once the IRA owns that investment, now the disqualified person's rules go into effect. So if you partner with yourself on your IRA, then your IRA would own a certain percentage of the property, let's say 50%, and then you personally would own the property at 50%, which means your IRA would receive 50% of any income generated, rental income. You would receive the other 50%. As far as expenses, it's covered at the same percentages that you established the investment. So if, again, 50-50, then your IRA is responsible for 50% of the expenses, and you are responsible for 50% of the expenses. So basically, anybody who partners on a new investment, has to receive the income, the revenue that's generated by the investment at the same percentages that were established at the time of purchase, and all expenses have to be paid by each of the partners at the percentages established at the time of investment. Okay? I talked about this. I got ahead of myself with this one. So disqualified persons, you, your spouse, your ancestors, your lineal descendants, spouses of lineal descendants, and then fiduciary. So if you have a CPA or somebody like that, they would also be considered a disqualified person. Again, that means after your IRA can't buy from or sell to a disqualified person, nor once your IRA owns a property can a disqualified person ever stay in or work on the property. But you can partner on a new investment, on an initial investment with anybody, including someone who would typically be a disqualified person. Okay? So here's some examples. You can partner with other people's IRAs. You can partner with other people's non-IRAs. And you can partner with multiple different people. So partnering is a way, if you don't have 100% of the money inside your retirement account to make an investment, it's a way for you to purchase that asset by bringing in other investors, including potentially your own personal savings or a spouse or a parent or other IRAs to make that investment. Again, each of the partner would own a certain percentage of that asset. So another strategy, using non-recourse loans. Your IRA is allowed to borrow money. There are financial institutions that will loan to your IRA in order for your retirement account to then invest in that property. And by law, it has to be a non-recourse loan. And I'll get into what that is. So essentially, it allows your IRA to purchase property where you don't have enough cash, right? So again, to use the example we did before, there's property for $200,000. You have $100,000 in your retirement account. You want to buy that property. Your IRA can borrow the other $100,000. So the loan is made to your retirement account. Your retirement account buys the property. Your retirement account receives all the income, the rental income that's generated, and your retirement account pays the loan back. So the loan is made to your IRA, not to you as an individual. So for me, okay, my name is Bill Neville. If I use my IRA to buy property, then the property is going to be bought by the Entrust Group for benefit of, or just shortened to FBO, the Entrust Group, FBO, Bill Neville, IRA number, then whatever my account number is, right? And if my account needs to borrow money to do it, the loan is made to the Entrust Group, FBO, Bill Neville, IRA number, then whatever the account number is, right? So everything is done in the name of the IRA. Title is on the property is held by the IRA. The IRA borrows the money. The IRA pays the loan back. So it's a way for you to use leverage in order to buy property inside your retirement account. But note, I said it needs to be a non-recourse loan. That means that when they drop the loan documents, whoever the lender is going to be, it has to be non-recourse, which means that the only recourse the lender has if you were to default is they can take the asset, the property itself, but they can't go after any other assets in your retirement account, and you're not allowed, and they can't go after you personally or any assets you hold personally, nor can you provide any personal guarantees on that loan, right? Again, because the loan is being made to the retirement account, not to you as an individual. You can't use any other, like your income or your personal home or anything like that can't be used as collateral, and you can't provide any personal guarantees because, again, the loan is not being made to you as an individual. So lender will loan to your IRA, not to you as an individual. The loan to value is typically a little more stringent than you typically see on a property, so expect that you're going to be looking at more like 35-40% down as opposed to 20% down. When the lender looks at the loan, doing the loan, they're not going to be looking at your personal financial situation, your personal income, your personal credit rating. They're going to be looking at the ability of the IRA to pay the loan back. So they're going to be looking at the finances of the deal. What's the value of the property, how much are you paying for it, what's the expected rent, maybe how much cash do you have in IRAs that you could potentially transfer more in to pay that loan back. But they're not typically going to look at your personal credit rating, looking at your personal income, because that doesn't really play a factor since you're not the borrower, right? And the loan payments must come from the retirement account itself. So either the IRA has to be receiving rental income to cover that, or you have the ability to make contributions to your retirement account in order to cover any loans and expenses that you have, right? They can't be paid out of your personal pocket. It all has to be paid from the retirement account. What's the pros of non-recourse loans? Allows you to get more properties, right? So again, if you have $100,000 and the property you think is a good investment is worth $200,000, it allows you to do that. It gives you the ability to buy more than one property potentially if you want to diversify into multiple properties. And then obviously you use the income generated by that property to service the debt. Some people do fix and flips, and if you get the IRA gets maybe a short-term loan to buy a property, fix it up, then turn around and flip it. And again, all that is processed through the IRA in the IRA that receives and sends the money. We do have a list of lenders that are willing to do non-recourse loans to IRAs. It's not a big list, but there are some out there that, and you're not limited just to this list. You can use anybody you want as long as the lender realizes that it has to be a non-recourse loan. They draw up the documents that way, and the loan is being made to the IRA, not to you as an individual. And cons, there is a limited number of lenders. Again, we have a list. So if anybody wants those at the end, you'll have the opportunity to request that non-recourse list. Just send that to us, and myself or somebody will forward that to you. You do typically see a higher interest rate, although I don't think it's dramatically higher. The loan-to-value requirements are a little more stringent. Again, the income must cover the debt, and if you default, then you lose the property, right? And so your IRA would lose that value. So you notice I skipped over the bullet point there for UDFI, or also called UBIT, Unrelated Business Income Tax. So I'm going to try and give a quick 1-minute explanation on how this works, and hopefully I don't confuse you too much. So I'm going to again go back to the example I used. Your IRA borrows $100,000 for a $200,000 property, right? So your IRA borrowed 50% of the money to purchase that property. The IRS perceives that 50% of that investment was using non-IRA money. It was using borrowed money. So 50% of your net income generated by that investment is going to be subject to a tax called unrelated business income tax, or the other side of the coin, it's the same thing, unrelated debt financed income tax. So in this example, let's say that net income, so after expenses, so after loan servicing the debt and after property taxes, insurance, maintenance, all that type of stuff, you end up with income of $10,000, right? Net income of $10,000. Well, at the end of the year, the IRS is going to look at that and say, well, 50% of that $10,000 was earned through borrowed money, through non-IRA money. So 50% or $5,000 of that $10,000 is subject to a tax. Now, it's taxed at trust tax rate. So there's it's a little bit different brackets tax rate than your standard income tax. But just bear in mind, whenever you're considering making an investment, if you're going to use borrowed money, and if you're calculating your return on investment, let's say your expected return on investment is 15% after expenses, you have to incorporate in that your IRA will be subject to a tax that will have to be paid, and so that might lower your return on investment from 50% or 15% to 12% or something like that, right? So it's not necessarily a reason to not do the investment. I mean, if it's gonna get you a great return on investment, just note that this tax that your IRS will have to pay will lower your return on investment, is all. And the form that gets filed to pay that unrelated business income tax is a 990T. The 990T has to be completed by you as the account holder, but you send it to us, and we cut the check from the retirement account and submit the form and send that tax to the IRS. It's got to be paid from the IRA. All right. Again, UBIT, UDFI. Most often you hear it described as UBIT, Unrelated Business Income Tax. And then the third strategy is investing in real estate through an LLC. So everything I've talked about so far assumes that the IRA is going to be the direct owner in a property. So if you buy a property, the entity that goes on title, that's buying the property, that goes on the contract and all the closing documents would be the Entrust group for benefit of your name and account number, right? And then any expenses that come in, the bill has to get sent to Entrust. We pay it from the retirement account. So we cut all the checks. Any rental income has to come to us to deposit into your retirement account, because your retirement account is the direct owner of the property. However, if you don't want to have Entrust write the checks, if you want to be able to control that flow, you can do so through an LLC. So what's called a single member LLC. So you can establish an LLC where your IRA becomes the member / owner. It's the entity that owns that LLC, is the member of that LLC, and you can be the manager of the LLC, right? So you make the decisions of what the LLC is going to invest in. You open the bank account in the name of the LLC, and then the LLC becomes the entity that buys the property. So your IRA invests in the LLC, and now the LLC invests in the property. So title is held by the LLC, but the LLC is owned by and funded by your IRA. Or if you want to do partnering, then the LLC members can be your IRA plus yourself or your IRA plus other investors, however you want it to be. But what the big advantage is this gives you checkbook control. So anytime you have a bill that needs to be paid, instead of sending that invoice to Entrust and Entrust paying it, you would pay it directly from the LLC because the LLC is the entity that owns the investment directly, right? Very handy when you're talking about partnering. Like an LLC can be very handy when you're going to be partnering because particularly if you have a tenant that's paying rent, instead of the tenant having to make out checks to multiple different partners or individuals and IRAs that own the investment, own the property, they can just make out one check to the LLC, and then anytime a bill comes in, the LLC pays the check, right? It gives checkbook control. Okay, so you would open up a checking account in the name of the LLC. You would have to acquire your own tax ID number for the LLC. You would also have to establish an operating agreement. So you're establishing an entity. The LLC becomes a pass-through entity that allows you to have checkbook control, right? But it's still IRA money. You as the account holder of the IRA, you can be the manager of the LLC. You can't be compensated, right? You can't receive any kind of compensation for being the manager. Let me think. I'm drawing a blank on what the other couple things. The LLC has to be vested in the name of the IRA, and it has to be a manager-managed LLC. It can't be a member-managed LLC if your IRA is one of the members, because an IRA can't be a manager. It's an entity. Okay? So you would create a business account in the name of the LLC. You would open that checking account. You can be the so that's not managing member. We need to correct that. It's manager because an IRA, so you would just be the manager of the LLC, and that gives you, once you open the bank account, that gives you checkbook control over the funds. And so now the IRA is invested in the LLC. The LLC can then turn around and invest in whatever you want to invest in. But it's incumbent upon you as the manager to make sure you don't do anything that's prohibited by the IRS. So you can't turn around and lend yourself money from the LLC or buy your own property or buy a property, your parents' property, right? You still have to follow the guidelines around prohibited transactions and disqualified persons. Again, and that's kind of what I was saying here. The LLC must ensure that the IRS meets all the Department of Labor tax rules and requirements and rules around prohibited transactions and disqualified persons. If you use leverage, then the IRS must still be paid the UBIT, and that's done through Form 990T. And then any revenue that's generated by the LLC, by the investment held by the LLC, if you want to take the money, so if you have your IRA that owns the LLC and you want to take money as a distribution to you personally, the money has to flow back to your IRA first, and then from the LLC to the IRA, and then from the IRA to you as an individual. And then you get taxed on at that point, unless it's a Roth, which grows tax-free. Have to set up the LLC with your IRA as the member, or at least one of the members, and again, a manager-managed LLC. And as I mentioned earlier, you can't receive any compensation. If it's your retirement account, you can't receive any kind of compensation or remuneration to be the manager of that LLC. So what are the advantages of using an LLC? It gives you checkbook control. I mean, that's the biggest advantage that you have is that instead of having to come to Entrust anytime you need a check cut, you can do it yourself. Same thing with rental income. It's very helpful if you are going to be doing a multi-member, if you're going to have multiple people partnering into an investment. Doing it through an LLC can make that much cleaner. Like I said, instead of having a tenant having to rake out multiple checks and each investor having to make out multiple checks anytime a bill needs to be paid, you can do everything through the LLC. So what are the cons? There's a cost, not to Entrust, but there are costs to establishing the LLC. Entrust does not provide that service. We don't set up the LLC for you. You have to do it yourself, or you have to pay somebody, hire somebody to do it, which is usually a lawyer. I have a couple of people that a lot of our account holders have used to set up their LLC, so I can always pass that on to people. And any record keeping, so any transactions that you do within the LLC, so if you buy a property, you need to track the rental income, and you need to track the expenses, and you need to keep records of that in the event that your LLC gets audited. We're not doing the record keeping for the LLC, or I'm sorry, for the asset owned by the LLC. We're record keeping the LLC itself, but any underlying assets that the LLC invests in, you as the manager are required to keep a good set of records on that. And then, and to mention the cost again, not only would you potentially have costs to set up the LLC, but you also, most states, if not all states, charge you an annual fee to hold an LLC. In California, it's $800 a year. So you potentially have some cost savings to what you pay to Entrust, depending upon how you're planning on transacting your account. But there also are costs that you will incur that you don't incur if you do not use the LLC. So to summarize, most of the time real estate investors are using self-directed IRAs because that's where they want to invest their money. They think that the best opportunity to grow their retirement account is through real estate. And so instead of being locked into just stocks, bonds, mutual funds, you can use your IRA to invest in other assets, real estate being a popular way to do that. And again, for strategies other than just having all the cash in your IRA and being able to use the cash to make that investment, you can also partner your IRA with other investors, including people who would normally be considered disqualified persons. Your IRA can borrow money through non-recourse loans, and then you can use an LLC, which gives you checkbook control over the money. The process is very straightforward. You open an account, which you can either do online through our portal. You fund your account, which either would be done by making an annual contribution, by transferring from an existing IRA, or by rolling over from a 401k or some other qualified plan. And then you purchase the asset, which you do by instructing us to purchase the asset on behalf of your IRA. So you find the investments you want to make, but your IRA is the entity that's making the investment, and you have to instruct us to do that. All right? Set up an account. There's the site for it. You can do it in about 10 minutes. Just go to theentrustgroup.com. You'll see a little green, I think, box at the top that says open an account. You click on that and just follow the information. It's like opening any bank account: name, address, social security number. You'll need to upload a copy of your driver's license or passport, and then credit card to pay the new account establishment fee of $50.